So welcome again, everybody, to this webinar on the benchmarking of the performance of infrastructure investor peer groups. So I believe this is this kind of analysis of unlisted infrastructure investments is a bit of a first. I'm quite proud to be presenting these results to you today. These are brand new results, never published before, and while performance contribution and attribution analysis are fairly common in other asset classes, I don't think this has been done before for infrastructure, and the results are really quite fascinating. So sit back, relax, and enjoy this webinar. Your host today, as usual, will be myself. I'm Frederick Blomberg, the director and founder of EDHECinfra, and I'm joined by my colleague Abhishek Gupta, who is heavily involved in the design and production of our indices and produced the results that you will see today.
Hello, everyone. I hope that you find this analysis interesting later down the line. Thanks.
I always wanted to give a special thanks to one of our colleagues, Leonard Lum, for his help in putting together the data that was used for this research today, and more generally to our wonderful EDHECinfra data team. Okay, a bit of housekeeping. We will talk for about 40 minutes and try and keep 15 to 20 minutes at the end for a couple of poll questions and also your questions. As before, we will take all questions in writing. Please use the Q&A menu at the bottom of the screen to open the Q&A window, or maybe at the top of the screen in your case. And if you add your questions there, we will try to answer some of them at least today, and certainly we'll try to answer all your questions eventually. This webinar is also recorded and will be reposted online later on. Again, very briefly, in the interest of time, and I expect by now most of you know this, we are EDHECinfra. We were originally purely an academic project at the EDHEC Business School, funded by private and public sector research grants. Today, we're also a commercial provider of indices for unlisted infrastructure investors. Our indices are used by major investors in the sector, from North America to Europe to Australia. And they use them for their investment research, to monitor their investment mandates, and to better understand the risks of their infrastructure portfolios. So today, our agenda, I will first describe to you what we're trying to measure here and analyze, and how and why, which is how and why certain groups of infrastructure investors perform. And I will then tell you a little bit how we've built these peer groups, namely by looking at investments made by the largest asset managers and the largest asset owners that are active in the infrastructure space. Then my colleague Abhishek will take you through the main part of the analysis and show you what explains the performance of these two peer groups by looking at the classic contribution and attribution analysis usually performed on active equity manager portfolios. And he will then take you through a risk factor analysis, also highlighting which risks explain the performance of each peer group relative to the market. And then I'll come back for a couple of points. First, to discuss why choosing the right benchmark is very important for this kind of analysis, and highlight the importance of having access to a granular set of market indices to do this. And then we'll have a quick poll, and I would like to ask you for your interpretation of these results, in fact, or some of these results. And finally, we'll wrap up and have our Q&A session. Okay, the objectives of this analysis today. It's very simple. We want to understand how two peer groups of infrastructure investors perform relative to the market and to each other, and why they perform the way they do. A second, more prosaic objective is to demonstrate how you can use the EDHECinfra index data, which covers all the segments of the TICS classification, to perform a return contribution and a return attribution analysis on any unlisted infrastructure equity portfolio, including your own. In terms of setup, we will use the TICS taxonomy to categorize individual assets in each peer group. So in the last webinar, we presented the TICS taxonomy in quite some detail. So I'm going to leave it at that today. Suffice to say that TICS is used by dozens of investors today to classify their unlisted infrastructure investments. It's also used by GRESB Infra. It's even used by the Global Listed Infrastructure Association. In other words, it's quickly becoming the sector standard. We will use the EDHECinfra platform to determine the right benchmarks. And then we will report everything in local currency returns. So we'll ignore any effect of foreign exchange. If you're a USD investor or Canadian dollar investor or an Aussie dollar investor, we won't look at that. We'll just assume everything is perfectly hedged or ignore the effect of foreign exchange. But all these indices that we'll use today could be used in a specific currency. In fact, they are available in 7 different currencies in the platform. All return computations that you will see are standard calculations you would make with any assets given some prices and some cash flows. All the returns that you will see are gross of fees or costs, that's important. And then what we'll show you are computations of portfolios of individual infrastructure assets, right? Not funds, with no extra leverage at the portfolio level. So it's kind of really plain vanilla infrastructure portfolio. Okay, the peer groups that we've built, what are they? So to build these peer groups, we've taken a very simple approach. We take the list of the largest infrastructure asset managers and asset owners by AUM. We take this list from our friends at IP and Real Assets, but there are other lists, but they're usually roughly the same. We look at the EDHECinfra universe of assets, which we track, which we've also described in the previous webinar, which is more than 630 companies. And we look at these assets that are both in this universe and in the top 20 asset managers and top 20 asset owners. Then for these assets, we get the investment dates and exit dates for these investors, for each asset, the percentage stake for each of these investments. And we recompose all this data using various sources like information. Now, with all this information, we compute the value and the returns of pooled portfolio for a group of assets that were invested by these large asset owners and a group of assets that were invested by these large asset managers. So an important point here is that we're not actually looking at a portfolio of all the assets made by these large asset owners and asset managers. Instead, we're looking at the intersection between the EDHECinfra universe and the investments of these large accounts. So still, because we pull them together, these portfolios represent reasonably well what large asset owners and managers tend to invest in and the kind of investment choices they make. And you'll see that the picture you get is quite familiar. We go back 10 years with this data. So here are our 2 peer groups. We have our top asset managers pooled portfolio, which includes investments in 118 assets over 10 years with 54 exits, 64 assets in the latest quarter, so still in the portfolio, which is the Q1 2020, representing at that date $53 billion of market cap and 21 billion of actual investment. That's if you combine the value of the assets with the actual stakes. For the top asset owners pooled portfolio, that only includes 31 investments made over the same period of 10 years, but only 1 exit, leaving 30 assets in the portfolio today with a $47 billion market cap and $8 billion of actual investment. Again, taking the actual stakes into each investment into account, which will of course impact the weights. So in terms of market cap, both peer group represents about 20% of the broad market universe from which they are selected. There's some clear differences in style, as you can see, from which are quite familiar. Large asset managers invest in more assets and they exit more often. Large asset owners invest in fewer, larger assets and they hold them to maturity. Both peer groups are more concentrated than the market. You can see this already with the effective number of bet metrics, which is at the bottom of that table, which measures concentration. But you can see that asset owners are a lot more concentrated in a few large assets than asset managers are. Okay, the list of all the assets in these portfolio is in the appendix of these slides, so we'll circulate that later. You can see from also in the slide the list of the top 10 weights in each peer group pooled portfolio. These are familiar names. You'll see that the largest weights in the peer group portfolios are very large. And the largest weights are more than 10% in the top asset manager portfolio, more than 20% for the top weights in the large asset owner portfolio, compared to a market where we already have some large weights, but the largest weight is just larger than 5%. So this is quite a familiar picture, I think, if you think of the different styles of these two peer groups. Now, looking at the top asset managers pool portfolio in more details, we see several differences with the market benchmark. We see a greater exposure by value to merchant assets. You can see this on the left. We see a small bias towards project finance, even though the majority of the portfolio is made of corporates, just like the market benchmarks. This is the central chart. And we see a clear bias towards transport at the expense of smaller sectors like renewables and social infrastructure. That's for the top asset manager pooled portfolio. And for this, we'll use the benchmark we'll use will be the global broad market benchmark. If we look at the pooled portfolio of top asset owners, there's a small bias towards regulated assets, but more contracted and less merchant infrastructure assets than in the top asset manager portfolio. So this is a big difference. There's a small bias towards corporates, so it goes in the opposite direction than in the top asset manager pooled portfolio. And there is the same bias towards transport than in the asset manager portfolio, but less pronounced. So for both peer groups, we are going to use the EDHECinfra Broad Market Index as the benchmark for two reasons. This is the natural market for these types of large investors. Okay, they invest everywhere in the world in all types of infrastructure. And for the sake of this exercise, it will allow us to make direct comparisons between the two peer groups because we'll give them the same benchmark. But given what they invest in, it seems fairly reasonable. One more caveat. In the end, these are ad hoc portfolios, right? As I've explained, this is the intersection of the portfolios of these top investors and our universe. They have in common to have been invested by a certain type of investors, large asset owners or less asset managers, but I have to insist that any specific asset manager or any specific asset owner may well have a very different portfolio than what we're showing you here. Okay? This is just a sample. But again, the picture seems quite familiar. Now, how do these two portfolios compare in terms of risk-adjusted performance? Now, this is quite interesting. The first very interesting fact is that both top asset owners and top asset manager peer groups outperform the market. Now, remember, I just want to make this really clear. Remember that these portfolios are made with a subset of the assets that are included in the Broad Market Index, in the benchmark. Okay, so there should be no question that we're comparing comparable things here. We just selected some of the assets in our universe by type of ownership and looked at when they were bought and sold and how much dividends they paid. But this is like comparing the FANG index with the S&P 500. One is a subset of the other. So the data is perfectly consistent and it's perfectly comparable by design. So our two peer groups of large investors outperform the market. They're also more volatile than the market. Now, how volatile? It depends in part on how concentrated they are. So the top asset owner peer groups has the highest concentration. Remember, it was the smallest one, and it also had the largest stakes. It also has the highest volatility. As a result, the top asset manager peer groups, which has the highest returns, also has the highest risk-adjusted returns. And that's of course the virtue of being more diversified. Looking at extreme risk measures like value at risk, we see that asset owners can also be exposed to some extent higher risk than the market and that the top asset managers peer groups, even though this has improved over time as the portfolio builds up. But what's also striking when it comes to risk is that the impact of COVID-19, so this is the quarterly return you see for Q1 2020 at the top of the table, shows us something different. We see that top asset owners experience a negative performance that's roughly in line with the market, -6.4. Market is -6.5. But the top asset manager peer group is hit by a -9.2% quarterly return. So remember that our top asset manager peer group was highly exposed to transport and highly exposed to merchant assets. So it got whacked by COVID much harder than the top asset owner peer group of the market. Or the market, sorry. Okay, that's the first result, right? Given different styles and exposures to the market, we see that the two peer groups have achieved a different risk return profile. But in both cases, they outperform the benchmark. So that's interesting. So I'm now going to let Abhishek give you the heart of this analysis with the results of the return contribution and attribution for each peer group. Abhishek, over to you.
Thank you, Frederick. Okay. And hello, everyone again. In the next 15 minutes or so, I'll walk you through dissecting the returns of these two peer group portfolios that we just saw. And note that these are all standard methodologies that we are going to see, which are used in the active public markets right now. But now with the help of EDHECinfra indices, this can be done for unlisted infrastructure asset class as well. First, I'd like to share some basic understanding for the analytics that are going to come ahead. Let's start with the chart on the left. We will show the return contribution by different segments of the overall portfolio as follows. And the numbers that you see in each of these contribution bars, they represent the absolute contribution to the total cumulative return of the portfolio. So they'll sum up to the total return. And the size of these bars will represent the relative contribution as compared to the total return of the portfolio. So there are two kinds of information in this chart here. Then simple enough. Then moving on to the attribution exercise on the right, we will follow the standard Brinson, Hood, and Biebauer approach. The idea here is to decompose the outperformance or underperformance of the portfolio against the benchmark. So that's what you see, the difference with the benchmark return on the right, by three effects: allocation, selection, and interaction. So first we take the allocation effect. It basically means that if the return of any segment is the same in a portfolio as well as the benchmark, then the only difference in the contribution of that segment will be determined by the difference in allocation to that segment. So if we freeze the return of, say, segment A in the portfolio as well as the benchmark, then we see this negative 18 basis points difference of the return that comes purely due to the difference in allocation. Similarly, we have the second effect of selection. That's a bit different in the sense that it means that if we freeze the return of this, it means if we freeze the allocation of this segment, that is, the allocation to segment A is the same in the portfolio as well as the benchmark, then the only difference in the return of this segment will be due to how the companies have been selected and how they have performed over time. The third is the interaction effect, which is basically the cross product of the two, and it combines these two effects of asset allocation as well as the return differences. Together, these three effects will sum up to the difference of segment A's contribution in the portfolio as well as the benchmark. And when we do this across segments, it will lead to the total return difference of the portfolio and the benchmark. So keep in mind this table, and we'll see this more often in the coming up analysis. Now let's apply this to first TICS pillar one, that's business risk. The three charts here, they show the compounded return over 5 years for the two portfolios that we saw, top asset managers and top asset owners, and the market benchmark. We noticed that regulated contribute the most performance in the two portfolios. This is also common in the benchmark as well, that there is a 9.4% from regulated assets as compared to 19.9% for the overall benchmark. So that's almost 50%, but the proportion is much higher in the two peer group portfolios. In the top asset owners portfolio, we noticed that contracted assets have the second highest performance across the three business models, whereas for top asset managers, it's the merchant business model, which has the second highest performance. That's also partly due to their differences in allocation. But I would like to point out one interesting thing here. We noticed earlier that top asset owners have lesser contracted than the overall benchmark. But in terms of the proportion, which can be seen by the size of these bars of contracted and the benchmark, they have a higher proportion of return of the overall portfolio. This implies that there is a better selection of contracted companies in the top asset owners portfolio. And we'll see this point much better in this analysis here. which is basically decomposing the overperformance of the two portfolios across business models by the three effects that we saw earlier: allocation, selection, and interaction. The figures represent the outperformance of the mean quarterly returns over a period of 5 years. First thing to note here is that both peer groups derive their outperformance through selection of companies rather than allocation by business models. So if you see this 1.59%, 1.64%, these are quite strong effects, and they both explain majority of the outperformance for the two portfolios. Within asset managers portfolio, we notice that most of the outperformance is driven by the selection of merchant and regulated companies, and that's the bulk of the effect concentrated here. And their underexposure to contracted business model leads to a negative almost 20 basis points of drag on the outperformance. Now moving on to the top asset owners portfolio, they do suffer from their underexposure to both contracted and merchant business models, and combined they have a negative 20 basis points effect. But they partially make it up by selecting better companies within contracted business models, especially that leads to an 80 basis points of outperformance. A significant proportion of the outperformance also comes from regulated assets, both by allocation as well as by selection. Now we can do the same analysis by industry types. This is in line with the business risk that we can decompose the portfolio returns over 5 years on a compounded basis. We notice that transport sector is the biggest driver of performance for both top asset managers as well as top asset owners, but it contributes a much smaller fraction of the benchmark. Network utilities is the second largest contributor, and energy assets, both conventional as well as renewable, along with social, they have very little contribution to the total return in the peer group portfolios, whereas there is substantial contribution in the market benchmark. This is owing to their smaller weights as well as lower returns than other assets. And finally, we notice that energy and water resources, which is made up of some very large gas pipelines, is the biggest contributor of negative returns in all the three portfolios. And that's in fact the most prominent negative contributor of returns. Now moving on to the attribution exercise by industry, here we see that both portfolio groups have outperformance reason of network utilities as well as transport security selection. Combined, they have asset managers have a 1.53% selection effect, and top asset owners have a 1.15% selection effect. So still majority is driven by selection of assets rather than allocation by industry groups. And this is quite interesting that their asset allocation we saw is a bit different from the benchmark, but it has little impact to the outperformance of these portfolios. And this is in line with the characteristic of this asset class, that they are highly liquid assets, and it's not very easy to rebalance them quarter on quarter. So most of the outperformance can only be driven by selecting better companies here. Now moving on to another text pillar, that's corporate governance. Here the story is also similar. Bulk of the outperformance is driven by large corporate assets, and that's also due to the higher exposure of both the portfolios to corporates. But we notice that for asset managers, projects have a significant contribution of total return, whereas this contribution is much smaller for top asset owners. And benchmark, this is quite sizable, approximately 25% or even more. Looking at the attribution exercise now, here we notice the similar storyline, that most of the outperformance is driven by selection of assets. But the key thing here is there are only two types, and corporates drive much stronger effect for top asset owners, whereas top asset managers also have effects from both corporates as well as project selection of assets. And a thing to note here is the top asset owners have an underperformance due to underexposure to projects. They have a negative 0.12% of return difference against the benchmark. So now, so far we have been talking about return decomposition, and in the slides that are coming up, we will also talk about how to decompose the risk by different factors in the portfolio. So first, we'll start with this classic CAPM style analysis to estimate alpha beta contribution of returns. For this, we take a time series of 10 years of quarterly returns and simply regress against the benchmark. And this you can do yourself by taking your portfolio's returns, downloading a benchmark from the platform, and performing this kind of regression. We notice that the fit is quite good, as indicated by the high R square. In terms of the findings here, we find that asset managers have a beta very close to 1, and they earn a much higher alpha of approximately 1.43% on a quarterly basis. As compared to that, asset owners on the, are exposed to more systematic risk, as indicated by their higher beta against the benchmark, and they earn less than half the alpha of top asset managers. So for asset managers, alpha contributes significant portion of their returns, whereas for asset owners, they derive higher returns by taking on higher systematic risk. Now moving on to the equity risk premium, some of you might be familiar with our asset pricing methodology. We compute risk premium for each company in our universe at each quarter. And these risk premia are used to perform mark-to-market valuations. And in our online platform, we also publicly publish this weighted average risk premium for all the indices in the platform. We can also compute the similar analysis here now for the 2 peer group portfolios and the benchmark. We notice that asset managers have the highest equity risk premium over the past 5 years, and it's even higher than the asset owners. And combined, both the peer group portfolios have had higher risk premium than the benchmark. And this is the significant driver of the returns that we saw earlier, that they both outperform the benchmark. Risk premium is ultimately made up of the risk factor exposures and the factor prices that we see, but factor prices remain the same across the 3 portfolios. So the driver behind these differences in the risk premium is basically their exposure to each of these factors. Here we look at 4: leverage, size, profitability, and investment. Top asset managers, we notice that have greatest exposure to the leverage factor. It's almost 85% in the past 5 years. Asset owners, while more comparable to benchmark, still have higher leverage, around 80% on an average. And this is what is explained earlier, that asset managers have higher risk premium. That's partly driven by this higher risk exposure to leverage factor. Asset owners, on the other hand, they have higher size exposure. So on an average, the companies are more than $5 billion in their portfolio, whereas benchmark is lesser than asset managers as well. And profitability and investment factors are more or less in line, although a bit increasing for the 2 peer group portfolios, but the exposures are still much more comparable to the benchmark. These exposures then translate to the contribution of each of these risk factors to the risk premium. Now, here we can basically see much more clearly that the marginal contribution of leverage factor is the strongest effect across all the risk factors. And since asset managers had higher leverage than both asset owners and benchmark portfolios, it contributes to their higher premium that we saw earlier. Size factor, on the other hand, is the predominant factor for asset owners having higher premium over the past 5 years. Again, we see that profitability and investment factors have almost marginal differences between the 3 portfolios. All right, with this, I'll hand it over back to Frederick.
We think it's fair to say that the broad market should be the correct benchmark for large asset managers and large asset owners that invest everywhere in the world in all sectors. It seems reasonable. But what if you're not an investor seeking exposure to all segments of the market? For example, what if you're a more specialized fund manager focusing on contractor project finance infrastructure? So that's a good example. And yeah, I just wanted to highlight the role of picking the right benchmark. So we've built another peer group portfolio, which is a subset of the top asset managers one. And then we're gonna see how picking the right benchmark actually changes the analysis and improves the analysis a lot. So we build this portfolio by keeping only the contractor projects, so project finance vehicles, contracted business model in the top asset manager peer group portfolio that we've built. So we get 60 assets over 10 years, with 18 still in the portfolio today after 42 exits, at a convincing portfolio size of $700 million invested today, market cap of 2 billion for the entire all the companies in the portfolio. Okay, so I just won't go too much into the detail for this because this is yet another example. And as you can see, these assets outperform the benchmark. Again, this is not too surprising because these are the same assets that were superiorly selected by the large investors. So we get the same sort of results. What's interesting is this, so that if you do the there you go. If you do the analysis in terms of beta and alpha, you get very different results depending on whether you use the broad market benchmark or the correct benchmark, which would be the contractor project benchmark. So in the EDHECinfra, with the EDHECinfra data, we can slice and dice the universe in many ways using text classification. In fact, we can produce more than 120, I think, infrastructure, equity, market indices or sub indices. So in this case, we're going to use what we consider to be the appropriate benchmark. And you can see that there's a big difference, right? So if you regress the returns of this fund or this portfolio against the broad market benchmark, you get a high alpha and a low beta. And as is often the case, and so if you use the wrong benchmark, you underestimate beta and you overestimate alpha. This is a classic story. And if you use the right benchmark, you find a beta of 1 and an alpha that's positive, but it's much smaller. So that's one thing that's interesting, and it goes to show that using the right benchmark for your infrastructure portfolio makes a lot of difference. Obviously, it's fairly straightforward if you've benchmarked active managers before, but in the infrastructure space, again, this is something that's fairly new and couldn't be done before. However, there's a different difference of interpretation here. Because normally when you break down returns in terms of beta and alpha and you talk about the alpha of the manager, it's because the implication is that beta is cheap, right? You could always buy an index fund and buy your beta for a few basis points. And so you only want to reward the manager for the alpha. Here in infrastructure, it's quite different. The beta is not cheap. There is no index fund that you can buy that gives you the exact benchmark for the segment, in this case, contractor projects, at least not yet. And so you might even argue that for the manager to deliver the beta, to deliver the strategy that was determined to be the correct benchmark, in many ways it's harder and it's more important than to beat the benchmark. Because for those of you who work in infrastructure, you know that it takes time to build an infrastructure portfolio. It's hard. It's hard to find the right assets. It's hard to source the assets. And so being able to build a portfolio that corresponds to a strategy that's well-defined, like one of those indices, is something that's quite valuable. You might even argue that it's more valuable, again, than beating this benchmark, which is more like the cherry on the cake than what matters the most. So there's a nice reversal of the usual interpretation of what does the beta mean or the alpha. Right, so now I want to launch our little poll and ask you 2 questions. So let's see if I can do this. 2 questions. One, what explains the superior investment performance, the superior investment selection abilities of top asset managers? What do you think? Is it their ability to source deals? Is it because they focus on large assets? Is it because they take more risk? Or is it because they're just lucky? Okay, I'm starting to see some answers coming in. And then we have a second question, which is what is more important in infrastructure? So kind of what I was just raising as a potential interpretation of these results. Is it to deliver the benchmark or beating it? All right, so I'm getting quite a few answers now. I'm going to wait for another. Okay, we have about half of the participants have responded. Come on, the other half. Come on, you can do it. And there's some clear winners also in this poll. That's interesting. So I think last webinar, I forgot to share the poll. So you only got to see it the next day when we shared it on LinkedIn. So what I'm going to do this time is try and remember to share it. Come on, wait for another 10 seconds. Hurry up. All right. Okay, so I'm going to end this here and share the results. I hope you can see this. Okay, so the winners are, to the first question, top asset owners and top asset managers have superior investment selection abilities because they have better deal sourcing abilities rather than because they're just trying to take more risk or they're just focusing on large trophy assets. Okay, I'm guessing quite a few large asset owners and large asset managers answered that question, but I think it's fair. I think it's fair that, again, delivering these investments in these portfolios requires a lot of skills. And it's interesting to see this business of the trade-off. I'll come back to this in a minute. The trade-off between focusing on selecting the right assets, which is different in different sectors and in different types of investments, and focusing on diversifying across segments. And probably there is a trade-off there. You could be less diversified across segments if your ability to select assets is stronger in one segment or another. And for the second question, it's a bit more mixed, but there's still a majority that agrees that it matters more to deliver the strategy than to beat the benchmark, which again goes with the idea that building these portfolios is difficult in the first place. And that's probably more important to build them well than to deliver something that's well-defined, like these benchmarks, than to come up with some other number in terms of performance. Okay. So let me go to the next slide. We'll close this. And it's the end. So two more things. First, what are our key results or key takeaways before we go to the questions? We have top investors, top asset owners, and top asset managers in infrastructure. We find that they perform very well because they manage to invest in the best assets. This is interesting because it means that there are other investors out there who don't manage to do that by design. Again, these are the assets that went into these peer group portfolios. They all came from the same universe. And so if you beat the benchmark, it means that there are other investors on the other side of that, which are not beating the benchmark. But they're not these large asset owners and large asset managers. However, these large investors are pretty poorly diversified, sometimes very poorly. And they're not really able to use asset allocation to different sectors or business risks to improve their performance. So we've seen in the results that Abhishek showed that the asset allocation part of the performance attribution was usually very small and often negative because of their style. These investors are underexposed to some sectors which otherwise perform. Right? They have positive returns. So if you're underexposed to a sector that performs, you lose out. Instead, what we also find is that these large investors are exposed to more risk than the market average. In particular, asset managers are exposed to more leverage risk, and asset owners, large asset owners, are exposed to larger assets, to more, you might say, to more liquidity risk, or at least size risk, at least. Overall, top asset managers are the best performers on a risk-adjusted basis because they offer not only higher risk exposures, but also more diversification. So that's an attractive thing. And I guess you could add that the fact that asset managers exit regularly their investment allows them to benefit from market timing effects, which are not available to the asset owners, the large asset owners, which are also by design, almost always by design, hold to maturity. And finally, this analysis gives us some insights into what infrastructure is like from a portfolio construction and a risk management perspective. Using asset allocation at the asset class level is tough. Right? Rebalancing is very hard to do, or in fact, you don't really rebalance your portfolio as and when, and certainly not every quarter. Security selection makes all the difference. So again, it suggests that there are skills that are involved here. And if selection skills are rare and different across segments, that's what I was hinting at before, then there can be a trade-off between diversifying across more segments or using your skills to pick the best deals in only a few segments. This is also the way, by the way, that TICS was built. So when we did the industrial classification of TICS, we were not just thinking in terms of the usual sectors, but also in terms of the deal abilities of different teams. And as you know well, the people who do roads, they're different than the people who do water, they're different than people who do renewable energy. These are different teams usually with different skills and a different background even sometimes. And so you might think of these skills as different buckets that you could develop or not, but they're all costly to acquire, whether you do this internally or you delegate through a manager. And so covering all the sectors means, and in order to select assets well, means buying a lot of skills, right? So maybe there's a trade-off between diversification and the cost of those skills. Right, that's one aspect of what we find. And then the final thing that I wanted to highlight is that you can do this at home, which is very timely, because using the data on our platform, plus your own portfolio data, you can derive all the results that you saw in this presentation for your own portfolio, at least for the contribution and attribution analysis. Right, you'd have to categorize your assets using TICS, using the taxonomy, but that's free and it's available online. We can even help you to do that if you have questions. And a lot of people already do that. A lot of investors already use TICS. You can pick the best index for your portfolio. In the platform, you'll find 120 combinations of equity indices. So you can pick the one that's the best benchmark. You can get 20 years of data on the returns of each of the TICS segment, a sub-segment of this benchmark. And from there, you can derive the return contributions of your portfolio. You can make the same attribution analysis, etc. And of course, you can also do this for debt indices because we produce a whole bunch of debt indices, and basically you could apply exactly the same principle. Right, so that concludes our work, our webinar, well, not quite a webinar, but our presentation on these results. This is, again, very new stuff that we put together quite recently on the back of our Q1 2020 results. It's quite exciting because we now see really the application and the industrial application of this work. And it's becoming something that we look forward to see implemented. So I'm going to now turn to questions and see, as promised, you have put your questions in the little window. Okay, so there were a few questions I've answered while Abhishek was talking, and also Abhishek has answered a few more. I might just very briefly, so there was a question about classifying things on the TICS. We covered this before. There There's a question about why the risk premium goes up. This is interesting. Actually, the risk premium increases in the last few quarters, but that's all. The risk-free rates in most countries actually decreased a lot. So the discount rates, the IRRs, have not necessarily gone up. In some cases, they've gone down, except of course in the last quarter with COVID-19. Otherwise, let me see what other open questions we have. Who are the losers? This will be the object of a different webinar, another analysis. As I was saying, there's clearly other investors on the other side of that market which are not doing so well, or perhaps who are overexposed to certain assets. I sometimes think that we should do a benchmark of the most unlucky infrastructure investor who ended up buying all the stuff that went bust in Spain and in the UK and in Australia and nothing else. And that would be the sort of the worst possible case. But we'll come back to it. I can't really answer this like that, but there's clearly, yes, another cohort of investors that is not doing as well as the top investors. Is it possible to see the category breakdown of the folks taking the poll? So that's an anonymous poll, I'm sorry. Yes, by type of, we could, yeah, why not? We could try if we can. We could try and break it down by type of respondent. Absolutely, that's a good idea. Thank you. We'll try and do that tomorrow. Would the return profile for the different asset classes be different for the different holding periods? Well, my questions are disappearing. Would the return profile for different asset classes be different for the different holding periods? Yes, of course, but I'm not sure what different asset classes you mean, because this is all infrastructure. So maybe if you mean sub-segments, then like contracted or merchant or whatever, then yes, certainly. Yes, this is compounded quarterly returns, so they change.
Just a quick note on that, right? We do notice that in COVID-19, there is different effect of selection and allocation attribution effects between merchant and contracted, for example. And this is highlighted in the 1 quarter returns that we saw earlier in the slides, that the asset manager portfolio, which has higher concentration to merchants, it has a higher negative return as compared to others.
Thank you. Yeah. Are there benchmarks that can be used to benchmark global that would include developing economies? So our benchmark does include some emerging markets, at least some parts of the world that are considered to be so. Malaysia, the Philippines, Brazil, what else? I forget, there's another one, but there are not too many. So depending on what you mean by developing economies, yes or no. There were other Latin American countries, but they don't count as developing economies, like Chile. So it would be, it's possible, but again, it depends. If you're interested in certain countries that we don't cover, then it might be a bit more difficult. Do you expect to run this analysis for private debt portfolios at some point? Yes, I'd love to. This will, Abhishek, whenever you've got time. we can do this as well. In principle, the same kind of analysis. I'm not sure how we would source the details of investors' debt, infrastructure debt portfolios, because usually that's buried in their fixed income portfolio or private debt. That might be more difficult. But we could at least make it by taking a very sort of generic example private infrastructure debt portfolio and then comparing that to the maybe 2 or 3 and compare them to the benchmark. A breakdown of the geographic base of the asset owners and managers included in the peer groups would also be insightful. Thanks. Actually, we do have this. It's at the end. So there's an appendix which will circulate, which has a couple of assumptions that we've used. And this is the breakdown of the peer group versus the benchmark. I don't know if you can see this. I hope so. Oops. And these are the list of the assets that are in the peer groups. Yes, subsegments. Okay. What are the risk-free rates used in the Sharpe ratio? So these are the risk-free rates for the local currency returns. These are the risk-free rates of the country where the investment is made at the time when the valuation is done, right? So that's the answer. Abhishek, is that correct? Yes, I think so.
Yes, yeah, I just replied.
Okay. All right. So I think we've covered everything. Thank you everyone for attending. Unless there are other questions, no, I think not. Thank you for attending again, and watch this space because we'll come up with more analyses like this. And one thing that would be interesting to know is if you think that it would be useful for us to start producing these peer group benchmarks on an ongoing basis, or if this is just an interesting exercise as a one-off. So if you have any views on that, we'd love to hear them. This being said, if we have no more questions, it's just been 1 hour, so perfect. Thank you again. Thank you, Abhishek, and we'll see you all very soon.
Thank you, everyone. Bye.
Bye.